you want to talk about screwing up your retirement is messing with your allocation when markets are choppy. You don't want to do that. It's very dangerous.
Right.
I mean, we've seen horrible days recently in the market, and we've seen amazing days. And you got to have the good with the bad.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me back.
Cory, we've got a very important topic today. The topic is reasons retirement plans fail and ways to avoid them. This might be one of our most powerful episodes ever. But before we go into today's show, I want to thank our listeners. Our subscriber count continues to grow, Cory. Credit to them. Again, if you think our show's any good, please give us a 5-star review and a thumbs up. The whole point of Upticks is to enhance financial literacy. Cory, before we go into it and play ball here, do you have anything personal you want to share with the potential millions of viewers out there?
I'm still living through a kitchen remodel, Jake. I actually wanted to ask you though, what are you doing at your house?
I'm
I'm
flipping
flipping
it,
it
Cory.
on
Yeah, I'm so weird how we sometimes our lives line up.
That's right.
I too am doing some home renovations. Real excited about that. Happy wife, happy life. Credit to me.
What are you guys doing? It's outside, right?
It is. So we are ripping up our entire back patio, which is this beautiful, huge brick patio, which I actually wanted to keep. And we're putting in a new brick patio. How about that?
Happy wife, happy life.
But the reason we can't keep it is that we're extending it and making it much larger. And if we would have kept the old patio and tried to add on to it, it wouldn't have looked good aesthetically. So we are putting in an outdoor grill. We're putting in a large patio, and then we're going to put in a pergola with an outdoor wood-burning fireplace.
Sweet.
Super excited about that because what I found in our new home, we haven't really entertained much at all yet. And the reason is our home really isn't, it's pretty formal in there. It's not really a house to entertain in. It's more of a home to entertain in the back because I have 3 back doors, believe it or not. So I've got a back door out my sunroom, I've got a back door out of my dining room, and I've got a back door out of my library. Mm-hmm. So I think the thought is that we're going to make that backyard really cool. So when we do have people over, everyone can kind of just, congregate out into the back patio. So this is the first start of that. And I'm super excited.
You can keep the riffraff out of your house.
That's right. Stay out of my house, Cory. You can go to the bathroom in the backyard or whatever and just stay out of the house.
It's like the golf course. Okay, good. Well, I'm excited for you guys.
I'm excited. So I've got a fantastic contractor. So if anybody needs some outdoor home renovations, let me know. And he told me probably July. So, I think hopefully he's underestimating. It didn't feel like he was overpromising. He's got to wait on the pavers and stuff to come in, but he got straight to work. He's already ripping things up, already cut my internet cable. Everything's going full blast. So
great.
We got that fixed, but it wasn't his fault. The internet company didn't market well enough. So, but anyways, we got that fixed really quickly. So
that's good.
So internet's back, and I'm sure they're over there, hopefully working today.
Excellent.
Let's stay tuned.
Let's talk about the financial plans and our topic today.
Yes. So I think we should ping pong this back and forth, Cory.
Okay.
So I want to start with a reason a retirement plan fails, and then have you talk, and we'll go back and forth. But I won't get on my soapbox. I want to hear your thoughts on on one of my reasons. So one of the reasons I was thinking of and thinking of today's topic is that, well, first off, let's play ball. Let's play ball here. All right.
There we go. That's right.
So one of the reasons retirement plans fail that I've seen, Cory, is that people underestimate their goals. Right? They may say, Jake, I'm making $120,000 a year, but I can live off of $3,000 a month. I don't need anything. I don't need to go out to eat. I don't need to travel. I just need, $3,000 and I'm fine. And then what happens, Cory, is these people retire and they're like, oh, but I didn't factor in my annual trip to the beach. And, oh, I didn't factor in my mortgage, or, oh, I didn't factor in this or that. So it's a big problem, underestimating your goals and your cash flow and your spending. That can ruin a retirement. And I'm not trying to scare people, Cory, but
Mhm.
you've got to get that number right, or at least be conservative, as in being on the high side, because that'll really mess up your plan. If you tell your financial planner you need $3,000 a month versus $10,000 a month, that's a completely different financial plan. Do you have thoughts on this?
I do. Yes, I was thinking about the same thing, Jake, in preparation for today. I was thinking about this, though, the concept of lifestyle creep. We've talked some about this on the show, but the idea for people that are working, as their income grows, it's not uncommon for people's expenditures to grow along with their income. Basically, their lifestyle creeps higher. Maybe they're not always saving the way that they should be, whatever it might be. But this, what we're talking about and what you're highlighting today, is almost like reverse lifestyle creep, which is people thinking, all right, well, if I don't have income anymore and I'm not going to work, I'm going to spend less money. But I think your point is exactly right, is that people assume they're going to spend less if they don't have income. But the opposite of that is spending more, as your income goes away. So ultimately, I think people have more time, and I think that can lead to spending more money. But I agree with you completely that actually planning for your real lifestyle costs and not what maybe fantasy costs should look like for you is a key to avoiding the same issue that we're talking about today.
Yeah, good, Cory. Let's talk about some real world. We're going to keep our clients anonymous, of course, but like, have
Good.
you ever worked with a client where they have drastically reduced their spending as they segue into retirement? I'm trying to think if I have any clients that have literally cut it by a third of what they were
Mm,
living off of. Do you have anybody that's done that you can think of? Most of my clients spend
not very
more.
many. Yeah,
Most of
I
my clients
have.
spend more money so let me talk about, most of them spend more than what they did when they were working like initially.
Mhm.
So they've got a bucket list, Cory, and they want to go on that Alaska cruise, or they want to buy a new house, or they want to do like you and I are doing, home renovations, or they want to buy a
Right.
boat, or they want to buy a Corvette. And credit to them, like we work those goals into the plan. But I'm not seeing a client retire at 55 or 65 and dropping their spending by a third. I just don't see it. Do you?
No, not very often. I was thinking about this while you were talking, Jake, because you mentioned kind of like real life examples here. I think that I've worked with clients that have made a lot more money while they were working than they needed. And I
Hmm.
think those are the clients that they really are planning for spending less money in retirement. But I hate to say, prove it. That's not the way I would put it. But I think that's, sort of drilling down to what it really looks like. Like, obviously, if someone's in a situation where they're making a lot more money than they need,
Right.
that's a situation where you've got a lot of flexibility. But I also have those same conversations, Jake, with clients about like, look, it's some people would rather work longer if that means that they can spend more money in retirement. And there's some people that at least will state that they're willing to spend less money in retirement if it means that they can retire sooner. But I think just answering which one of those is more important to you is a serious question, maybe to kind of think through. Like, am I willing to work longer if it means that I can have the lifestyle that I want? Or is the lifestyle that I want not really what I need? And I've got what I want, and maybe I can retire sooner.
Yeah, that's good. But the $10 million question, though, the problem, Cory, I
Mm,
have with the budgeting in retirement is that, how are you at 55 or 65, whenever you retire, how are you supposed to know how much money you're going to need every month for the next 30 years? Then this is what scares people.
mm,
And this is why I am confident that people are worried about running out of money. And yeah, they worry about the stock market and investments and inflation and all that other stuff. But they
sure.
also, how are they supposed to know what they're going to need? And
That's
how
kind
do
of
you
like
answer?
asking an 18-year-old when they go off to college what they want to do for the rest of their life and
Yeah,
study.
yeah, but this is even more serious than that. I
Even more
mean,
serious.
I
Same
think it is
concept,
more.
though.
Yeah, yeah. So how do you answer that question, or how do you guide clients through that decision?
The great question. So the way that I guide through that first is by strongly encouraging, we get a good sense of what the income is right now and what the
Right.
expenditures are right now. Beyond that, though, it's also actually naming some of the specific goals that people have in mind down the road, whether that's another home, if it's a camper, if it's paying for grandchildren's education, whatever it might be. But specifically naming those goals, assigning dollar amounts to those. So even if somebody has a big financial goal for 10 years from now, maybe it's 9 years from now, maybe it's 12 years from now. But either way, we're planning for that to happen. And we know that expenditure is mapped out. But it's when, in my experience, when people have big things that they want to do that they don't have a plan for, is what can derail that.
Right, right. And we've got a little bit of an ace in the hole too, Because
Sure.
what we do when we do project these plans, like let's say somebody's taking home $8,000 a month.
Mhm.
I typically say, all right, we're going to plan on you taking home $8,000 a month for the rest of your life, increased for inflation. And our ace in the hole, Corey, is that actually people's spending typically goes down as they enter the slow go and the no go years. But we can account for that, but we normally don't, to give the plan some cushion or a buffer. Also, I don't always do this either. Like if somebody has a mortgage and it's going to get paid off in 10 years or 15 years, I typically don't have that rolling off the plan either. So I like to
Mm.
build in some cushion so that if they get into retirement and they're like, Jake, yeah, I told you I was clearing $8,000 a month, but I really want to start spending 9 because I've got this other hobby that is going to cost me a 12,000 a year, whatever, maybe you're on a sailboat or whatever. And it costs 12,000 a year to maintain your boat. I don't know, whatever. Right. So we can build in some of that cushion so that we're like, okay, well, we think you're not going to do that forever. So maybe you do that for 10 years. And then in 10 years, you spend $7,000 a month or $6,000 a month. So again, we want to give slack in the plan
Yes.
because I don't think it's any way to retire, Corey, to be so rigid knowing you're on a fixed income. Like that's what I hate hearing that when people say I'm on a fixed income. I mean, to me, that means you're on Social Security and annuity and that's it. And your life should get to be more fluid than that. If you have a nest egg,
That's
say,
good. Yeah. Yeah, that's a great point because the fixed income that you're talking about, Jake, it's like there is, I mean, I guess that's a choice, right? It's a choice
Yeah.
to live on that fixed income. And
Right.
we have plenty of clients that have found employment and income in retirement.
Sure. That's another way to help the plan. Absolutely. To help those things.
So just to wrap into all of this though, Jake, I think one, another reason that financial plans fail in retirement, but two, I actually think it ties into what we just talked about, is sort of I'm going to call it a drought of purpose for what people want to do when they're not working anymore. Because I think that if someone doesn't have a clear idea of what their life is going to look like when they're retired, it is important to recognize that it is not just a single point in time. Like it's the start of something else. It's not the end of everything. And retirement's a pretty dynamic phase. It's not just like some fixed end point in a financial plan. For some people, it can be decades. So I think you need to plan for the money, but you also need to plan for your meaning or your purpose or what it is that you want to do. And I know that might sound a little, I don't know, Pollyanna, if that's the right word. But the reality is that if you don't have that purpose, no direction or sense of contribution can lead to depression, not joy for someone in retirement. And
Right.
I think that the purpose is also what helps people get their money aligned. Because without that too, it's just sort of like, well, as long as I have more money, everything's going to be okay. But if I don't have money, everything's not going to be okay. It's that there's no purpose for the money.
Good point, Corey. Yeah, we always talk about this, but we probably can't talk about it enough. Is that you got to check in with your values and what's important to you and why money is important to you. I love asking people that. Why is money important to you?
Right. Yeah. And you know what's interesting about that question, Jake? I heard this the other day. Somebody said do you know what the difference between beliefs and values are?
Let's hear it.
Beliefs are what you think is true. Values are what you think are important.
Oh, nice.
Pretty good. Which is pretty good. So, beliefs and values, sometimes those things can get a little misaligned. But I think to bring all of this back to the point that you're making, I mean, it's just a matter of what really is important to you, because there is always going to be somebody else with more money, just like there's always going to be somebody else with less money. It's a matter of figuring out what matters to you and what you want to do. And to recognize that without any direction or sense of contribution. I just met Jake with a prospective client yesterday who wants to plan for retirement this year. And he told me that I was asking him the scary questions when I started asking him, like, what are you going to do tomorrow if you weren't working?
That's good. I'm glad you asked those questions. Hopefully he appreciated that.
He's like, those are the scary questions, Cory.
And you don't have to wait till retirement to have those questions.
Of course.
Like, I feel so aligned. Now, I manage money for a living, but I feel so aligned with my spending and my money that I'm spending a lot of money on this home renovation on the backyard, right? But I was joking, happy wife, happy life, but I saved for it, I budgeted for it, and I know what's going on, and it's not a big deal to me. It's a lot of money, but I'm not stressed about it. It's what the plan is. Like, I'm not wasting money other places is the key here.
And what you just said though, Jake, is so powerful because of the way that you framed it. And I want to be clear on this. I think that the way that you view your work and your purpose and what you bring to that, I think is probably a big differentiator. Because if both of us, frankly, if both of us thought about our work in the sense of like, I only want to do this for as long as I have to, so that I don't have to do it anymore.
That would be a horrible way to live.
Right. And
I shouldn't laugh because I think a lot of people are living that way. And
that's right. And I know that not everybody has the same, we have obviously worked very hard, and I'm grateful that we've, established our business, and we, have a healthy situation there. But when you really think about it, like everything that you're describing, if you just didn't spend any of that money, Jake, and you and Rachel were just saving and investing all of it, I'm confident that you could really fast track your own retirement. But it's clear also to me that you're not just thinking about like walking away from your work and what you do, that the purpose you as a person that you bring to it is big. And I've thought a lot about this too, because I've looked at my financial plan and my retirement plan with our financial planning team, just the same as our clients do. And it's like, this might sound a little crazy. My wife might not like to hear me say this, but I'm kind of like, I hope that I die while I'm working.
Yeah,
and I hope that I love what I'm doing.
Did you tell me that the other day?
I did. Yeah, and that's such a shift, but I mean that from a sense of like, it doesn't need to be about money or not about money, or about purpose or not about purpose. Like, obviously the purpose is important, and it's going to be crucial, but I think the lens in which we look at our work can be really foggy for a lot of people.
Right.
And they sometimes don't find that out until after they retire.
Yeah, exactly. And it's probably easy for us to say because a lot of people aren't in our situation where they had the opportunity to start their own company, but it doesn't matter. And many of our clients work in corporate America, and they do love what they do and they do have purpose, but they also understand that they can't do their job forever, because at some point, maybe their value or their impact diminishes, or maybe the company's changing so much, Cory, that they don't want to roll with those changes. And that's okay too. But I think what you're getting at is having a purpose and lining that money up with your purpose.
Exactly.
And that is a way. So I like that as a second option. A way of a retirement plan can fail is not having your values and your money aligned.
Exactly.
Then you're probably going to be, then you stand the chance to be miserable, not only be unhappy, but run out of money, which is scary on both ends. So hopefully we can help hedge that off. So can I throw out another one?
Please.
I got another one. A retirement plan fails is adjusting your investments during market volatility, which is very pertinent today. And I've been very happy and pleased with our clients' behavior through our recent market volatility, Cory. But this is evergreen because stocks are volatile, like that's in their nature. Right. But you want to talk about screwing up your retirement plan. If you capitulate and the stocks go down and you decide to sell all of them and you don't get back in for 2 or 3 years, you're doing permanent damage to your trajectory of your financial plan, and you could run the risk of running out of money and vice versa. So you just have to be very careful, but you don't want to change your investments unless your plans have changed. Don't change your investments because of the market. Like, we're rebalancing and we're buying and selling. I don't want to just say sit on your hands either. You need to make sure you know what you own and why you own it. And that's why people hire us to understand that and explain that to them. But you don't want to start fiddling with your asset allocation just because of the market, because now you're saying the plan has no value. And so
that's exactly right.
Yeah, we build the plan knowing the stock market's going to crash.
That's right.
We create a financial plan. We know the market's going to crash. We just don't know when or why. But we know it's going to happen. And so we factor those things in. So you would talk about screwing up your 30-year, a lot of people will say, well, Jake, I'm retired. I can't wait to make this money back. And, and I always tell them, it's like, well, you have to understand that you're not spending this money today because we have an adequate amount in bonds and cash. That you've got to be patient to let this come back. And what's funny is people forget it was as early, Cory, as 2022, right? 2022 was a horrible year in the stock market. And I would argue the average investor, the average person doesn't remember that. I think if you walk down the street and you ask 3 random people on the plaza and you said, do you remember when the last negative year was? Do you remember how much it was down? And do you remember why? I bet I bet no one would know all those answers.
I feel like, Jake, we need to take this to the streets with the microphone
I want to be street
and start
reporters.
interviewing people. But I hear you loud and clear, and I agree with you.
But it just happened. It just happened.
It just
and then
happened.
we had two really, really good years. And so my point is, you have to understand, to make money in the market, you've got to risk money. And we don't like index funds. We don't like products. We think you should own a diversified set of stocks and bonds. Know what you own and why you own it, but you don't want to be fiddling with that. You want to talk about screwing up your retirement, is messing with your allocation when markets are choppy. You don't want to do that. It's a very dangerous.
Right.
I mean, we've seen horrible days recently in the market, and we've seen amazing days. And you got to have the good with the bad.
Yep, that's really good. And I think that that's really good, because I've thought a lot about this too, Jake. And I've had people that have asked me this over the years, like, do clients call you guys and freak out, right, when the market gets hairy? And the answer is sometimes it depends, right? It's circumstantial. And I get it. But I've had some people, Jake, who have said, like, what exactly does somebody expect you to tell them, right? If the market is really volatile, like, is there a button that you're supposed to be able to press to fix it? Is there something that you're supposed to be able to change? But where I'm coming from, and I say all of this like tongue in cheek, but the point that I want to make here is that if someone wants to panic and really shift up their investment allocation, I would argue that is because there's a misalignment with the financial plan in the first place. Like, going back to what we're talking about here as far as the purpose and everything else goes, like, yes, of course, the money is important. But I would argue that for clients that recognize the money is important, see the value in the financial plan, understand how the portfolio is funding the financial plan, there's just not any major reason for concern when the market gets volatile, because they know how it's all working. But if someone's value or their comfort or their happiness in retirement is just tied to that, that's when people want to just freak out, right? Or make some drastic decision. It's sort of like, there's clearly a lot of emotion wrapped up in it that for some people is wrapped up and for other people it's not. And I understand everybody's different, but there's something there.
Right. They may have a high watermark. So they may say, if my account ever gets under 2 million, I'm going to be really freaked out.
Right.
Even though it could do that temporarily and come right back above it. But
and not change anything.
Right. That's good. Let's move on here and talk about, have you ever seen a retirement plan fail because of an emergency? Because I think that's what concerns a lot of people. Like, have you seen somebody deal with a medical emergency, or maybe their kid or a family member, or I don't know, their house got washed away? Have you dealt with anything like that? Because I think I think it's a valid concern that people have. Like, but have you seen anything like that, or have you had to help a client through an emergency like that, where their financial plan was severely altered because of it? I don't think I have. I've had literally thousands of meetings over 19 years. The key is you got to have health insurance.
Of course.
Right? Because people always worry about that. Why? I don't know why, but they always say, like, what if I have a medical issue and it drains my account? Well, you wouldn't, because you have health insurance and you've got a max out of pocket usually, right? So the key is you got to have...
Yeah, and understanding what your Medicare maybe covers. That could be part of, Jake, where that comment comes from. But I hear you loud and clear. I agree.
We have a lot of clients, and I've had a lot of meetings. And I've never had somebody say, I have a $200,000 medical bill because I wasn't adequately covered. Like, we don't deal with that. So the key is you got to have, and I'm sure some people deal with that out there, but like, our clients typically don't have that issue. So the key is you got to have adequate health insurance coverage. I've had people had to go into like long-term care facilities, but that's another fear, I think, of people, of those types of places draining you. But you just plan for it. And the sad reality, Cory, is that the average stay in those places isn't that long. I know some people may stay in there many years, but
of course,
sadly, a lot of people don't. And so the expectation is that unless you have a family history of dementia, you're probably not going to be in that place for a decade. And so also, if you have to go to a retirement community or a home or whatever, you don't need your house anymore. You don't need your car anymore, right? You want to talk about major downsize, is that you can sell all those things and pay rent. And the rent can be pretty expensive, but as long as we have it in the financial plan, a lot of times our clients can self-fund those types of events in their lives. But the only time I've seen clients is when they have made drastic moves in their plan and decided to cash in everything to do something extreme, but it wasn't an emergency. It was just that they pivoted.
Yep.
And they wanted
I
to do
agree.
something. Yeah.
The example that is coming to me, Jake, that I think is, it again, speaks to another point that I want to make here today is maybe not so much a surprise, but this is a bit morbid, but it's a reality. I think the situations that I've needed to guide clients through that are aligned with what you're talking about here is, frankly, if, one spouse passes much more prematurely than the other one planned for, because then they both planned for, and we planned for, because of the way insurance works, the way taxes work, all of that, and how that can change the trajectory of someone's plan. I think the bigger point there is, and the point that I want to make too, along with this, is recognizing that financial plan is a living document, because life happens and things change and we want to evolve with it. We don't want to just establish a plan once, put that binder on a shelf and then disappear. And recognizing too, though, that, things happen and we may need to make some adjustments along the way. But I think that's more common than anything else. And it's not super common, but it's a reality that people have to navigate.
Yeah, you're right. You're right. And you're right. The plan is a living, breathing document. I hate calling it a roadmap. It's a pet peeve of mine when I hear other financial advisors call a plan a roadmap, because maps aren't supposed to change.
Right. It's like, here's how you can get exactly where you want to go.
That's not how they work.
I know.
It is a checkup. A financial plan is a checkup. And shame on the wealth advisors that don't build plans to begin with. But I would also equally shame the wealth advisors that build a plan and don't review it. Because I have new clients that have both. I have new clients that their advisor never even built them a plan.
Right.
But I would almost argue, Cory, it's worse to build a plan and then never update it, because then I would argue that advisor used that plan as a sales tactic, but they really weren't serious about it. And so that's why I think it's worse, because you showed your client your capability, but then you never followed up on it, versus the advisor that never did one in the beginning, just never did one. So they never even had a plan. So you can't, it's almost ignorance. So the key with the plan is to create one and update it regularly. And I'm talking at a minimum once a year, and ideally 2 or 3 times a year, or anytime you have a major life event change.
Absolutely.
Now, what's great, Cory, is we're not attorneys.
That's right.
Credit to us. So we're not going to bill our clients by the hour to update their financial plan. So we don't have any incentive to meet with a client 1 time a year versus 10 times a year. And this is the problem in the industry, though, frankly, is that's why advisors don't meet with their clients, because they're not financially incentivized. But for us, Cory, we truly care, and our reputation's on the line too. Like, we don't want a bunch of clients running out of money. No. That's bad for business, right? So we want clients who have solid financial plans, who are updated, reviewed, and that we're adding value. Maybe one meeting we find a way to lower your taxes. Maybe one meeting we help solve a debt issue you've been dealing with. Maybe one meeting we find a way to help fund your grandkids' college education. Who knows? The meetings go in such a variety of different directions. That's why they're not maps, because your life is changing and evolving, and we just want to update and check in with you. It's a checkup. That's what it is. And so
that's right. That's great.
But that's another reason a retirement plan can fail. If you want to talk about another, is not updating and reviewing your plan regularly. You want to talk about a way to fail? That's one way to do it.
I agree completely. Yeah, the plan is a snapshot in time, but the plan is not like a movie that's already been written, right? Things change, life happens. It's a dynamic phase. And I think and again, credit to our clients, Jake. I want to mention this. I had a phone call with a client just yesterday, and they literally made the comment. It's like, well, this isn't what I planned for, or we probably planned for the market at the beginning of the year in 2025. Right. This was the comment. I said, but what should we be looking at or doing right now to take advantage of it?
Yes. That's the way to think about it.
That is the way to think about it, is say, okay, we recognize that things that we don't plan for happen all the time. But in terms of the financial plan, we can structure it to absorb the things that we can't plan for. But when those things do happen, it doesn't mean let's freak out and blow up the portfolio. It means let's stick to our plan and take advantage of this. Because it's interesting how some people can want to panic and sell their stocks, but then other people are like, this is the right time to buy. Let's put money to work, right? This isn't financial advice. I'm just saying, broadly speaking, it's interesting how split people can be.
Yeah, and in full disclosure, it could get worse before it gets better.
Of course.
But our argument is that if you have cash that you don't need for 5 or 10 years that you're sitting on, and you don't have it earmarked for any other goal but your long-term retirement, well, the stock market may be cheaper than it was 4 months ago. So if you bought XYZ stock for $100 and now it's trading at 80, and maybe you can average down is what it basically is, and
Mhm.
lower your average cost for that stock with the hope that it goes up. Now, again, there's no guarantees. We don't know what's going to happen. We don't know how this is going to shake out. But the key is, I agree. I would much rather have a conversation. I'll have any conversation, but
Of course.
the way to think is that you should look at opportunistically. How can I take what's going on in the world, which I can't change, I have
Correct.
no impact on, but how can I take what's going on and apply that to my situation to hopefully come out of this better than I was before?
That's
And you
right.
can do that in good markets, bad markets, sideways markets. You can do that. You can do that anytime. Like if you came in to your meeting with your wealth advisor and said, "Okay, tell me what's going on and how can we benefit from it?" That'd be a great conversation to have every time. What's
That's right.
going on and how can we benefit from it? And
Absolutely. Actually,
I think
that's a
that's
really great way to frame it.
that's a great, because you can play the victim card and woe was me and I don't like that the market's down and you can do that, and I'm not discounting those emotions or those fears, but in the end, Corey, there's nothing you do about it as
Yeah,
far
and
as changing. You can't
yeah, and it's not
change
going
that
to
the
bring you a lot of
market.
peace either.
No, you can't change that the market crashed. You can't change that. But you can look at your plan and your situation, understand your plan, and say, "Hey, is there anything we can do?" And sometimes maybe there's like, you know what, there's nothing we can do. We just got to ride this out.
That's right.
Could be a good market or a bad market or whatever. Or like if there's no tax planning for you to do just because of the way your plan is structured, there's no tax planning for you to do. But at least you're checking in on it. And that's the key.
Yes. Yeah,
So
that's really
important.
good.
It's really
Yeah. So
good. Good.
again, I think it's about the vision, sort of, right, or the phase in life, and it's not just about the portfolio.
Right.
And retirement without any real meaning is what can be empty. And I think that's what
Yeah.
is how people can end up just so emotionally attached to. They feel good if the market's up, they feel horrible if the market's down, and they feel like their fate hangs in the balance of what happens day to day. Doesn't need to be that way.
It doesn't need to be that way. You're right. You're absolutely right. All right, good, Corey. That's a good place to land today's episode. You got any final comments before we wrap up here?
Yes, the last thing I would say, and I would share with people that we didn't get to today, is continue to invest in yourself, whether it's your health, your mindset, mentality, whatever. You can continue to grow in retirement. It doesn't just have to be the end.
Yeah, good one, Corey. And that's goes with my say, invest with intention. That's how I'll leave it. Invest with intention, plan with intention. If you do most of what you do with intention, that's a pretty cool way to go through life. So thank you, Corey, as always, for joining me. Thank you all for tuning in, and we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.